Do the markets care about what the Fed has to say at this Jackson Hole symposium that's going on in Wyoming right now? Does it matter? Are they going to be on pins and needles when Jay Powell takes the podium tomorrow? Or is this all just a repeat of the same old, same old? That's what we're going to ask today on Macro Money. Welcome. This is Ilya Spivak, head of Global Macro here at Tasty Live. And we've been having quite the lively debate here at Tasty Live. If you had a chance to catch overtime right before our conversation here, there's been all kinds of opinion and all kinds of prognosticating around what this might be and what this might not be. And so that's what we're going to do here. I am going to shamelessly plug my perspective unopposed here with some charts that hopefully illustrate what could be the signal out of markets ahead of this thing, and how then investors might react when it actually occurs. Let's begin with essentially where we are after the price action that we saw today, which, shock of shocks, ugly. And the first thing we're going to look at here is just a chart of NASDAQ futures. That's because, of course, they were open to trade when earnings from NVIDIA crossed the wires after the cash equity close yesterday. And you can really see the response. The company, of course, the darling of the AI hopeful, that look at AI as the next great thing that is going to propel the tech sector, which is itself the thing that everybody has been looking to be the driver and the market leader for equities. If we take a look at the performance for the S&P 500 this year, we have about a 7% year-to-date gain without tech and an almost 16% year-to-date gain with tech. So the tech side of the equation, obviously a tremendous component of what's holding up these markets. And NVIDIA and the AI story that it sort of encompasses and leads, because of course it has tremendous first mover advantage in terms of being the hardware and software supplier, infrastructure supplier, data center supplier for the AI portion of the tech space. Because of this was, of course, a tremendously consequential event, even just from a macro perspective on the macro calendar, equities aside. There was a tremendous level of speculation and expectation because the first quarter report was very robust, and that was clearly a very supportive thing for risk appetite all across the markets for weeks and months thereafter. We got another very potent, strong report yesterday. You can see it on the screen here. What you find is that after that report came out, standstill. And as we got into the European session today, NASDAQ futures, along with stocks in general, began to sink. And not only did they begin to sink past where they were before NVIDIA reported, as central as NVIDIA is, and as central as tech is for markets, something was clearly so much more important that we've now erased all of those gains and then some. Looking at how we're performing here on the week, here's a daily chart where essentially one bar is 1 day, and we can see that we're very quickly approaching the lows of the week. So what NVIDIA gave us was a potent upside gap. We have now completely erased the gap, completely erased yesterday's gains, completely erased the prior day's momentum, and we're actually eating into Monday's attempted recovery bar. So the NASDAQ looks absolutely awful. This is not just the NASDAQ, and this is not just tech, though, of course, that's an outsized contribution around U.S. equity markets at this point. The S&P 500, a more kind of catch-all, less tech-leaning than the NASDAQ kind of index, although, again, it is outsized. Same story. Ugly, ugly day. A candle where all of the prior day's gains are being engulfed, and we're, again, starting to inch to where we opened for the week. Now, it keeps going as we start to look across the markets and start to get a sense for what are these stock losses all about? What is it that's motivating this? Here's the euro, and we look at the euro as a measure less so of the euro itself, although that's certainly a part of it, but also as a kind of view on the U.S. dollar. Because, of course, when we consider what the dollar's most liquid counter expression is, what's sort of the way to catch something that is the closest to an average move for the dollar against its major counterparts writ large, it's the euro. This is by far the most liquid expression of the dollar. And what we see here is the dollar is up. In seeing these euro futures decline, what we're looking at is a dollar that's higher. And if we were to look at the individual crosses, it's higher against the yen, the pound, the Australian dollar, the Canadian dollar. It's up across the board. So we know that we have stocks down, and we know we have the dollar up. This already speaks to some notion of risk aversion, to some notion of the market saying something is clearly very worrying. We're going to cash out. What's the cash of choice into which we're going to go? As ever, it's the dollar because it is the most liquid, and so it is the most able to absorb big capital inflows without moving so much as other currencies. And of course, when you are looking for a cash venue to cash out into, when you're looking for any kind of haven, the thing you're trying to escape is volatility. The more liquid something is, the less volatile it is. And there's nothing in the known financial universe that is more liquid than the US dollar. So, not surprisingly, stocks down, capital is leaving risk and liquidating, so the dollar is up. Why? Well, needless to say, we have this Jackson Hole situation that now looms in front of us. This is an annual symposium that the Fed conducts whereby they get all the key Fed officials, a bunch of international officials from other central banks, a bunch of sort of monetary policy adjacent economists and academics from universities, from the IMF, from the World Bank, and gather everybody for a kind of who's who powwow once a year in Jackson Hole, Wyoming. And the idea usually is to tackle some kind of an economic issue that is a present and a critical issue for global monetary policy, not for any one central bank, not for any one policy maker, but something that is big picture, something that is bird's eye view for everyone. And for the Fed, this sort of exercise is a kind of annual lens setting where They come out and they're not going to announce policy. They're not going to suggest that this or that is going to happen with rates at the next meeting or the meeting thereafter. What they're going to do, rather, and what they've done at these things before, is essentially say, here's what we care about. Here are the policy outcomes that we think are critical. Here are the challenges in getting there. Here's where we think we're steering. Not in terms of specific rates, not in terms of specific policy moves, not even perhaps in terms of specific timelines. What they're doing is they're calibrating the market's lens, saying, here is where we think we're going over the next year, aspirationally speaking. Here's what we want to achieve. You should be interpreting incoming information with this perspective so you too can play armchair Fed chair and get a sense of how we're likely to respond in the face of that information, in the face of those developments. So if XYZ thing happens economically, you can look and say, the Fed is going to do this thing given this news because this is what the Fed cares about and this is where they want to go. That's what this speech from Fed Chair Powell at the symposium is going to look to do. At least that's what it's done now over multiple Fed chairs, and at least in the near 2 decades that I've been looking at them. So with that in mind, you might look at the price action as we've seen it and said, the market's afraid of the Fed. It's afraid of the Fed because it thinks the Fed is going to come out and beat the drum of we have to get inflation down and we're not going to stop and we're not going to back away from rate hikes. We might even go again this year. Never mind the fact that the Fed is probably not going to be that specific in any case at this venue. But for whatever reason, the price action perhaps is afraid that we are going to be in a situation where the Fed is going to sound at least as hawkish as it sounded in July and in the minutes from July's FOMC gathering that we've just read last week. And with that, the market is going to be faced with a less friendly Fed than it would like. Maybe that's the reason for this risk aversion. There is some evidence on that score. If we look at the 2-year bond, we can see that it is down, which means yields are up. And so the 2-year, which is the most sensitive because it's closer toward the short term as far as borrowing costs go, it's more sensitive to what the Fed might do or not do. There is clearly some response here. Yields are higher, dollar is up, stocks are down, tech is down a lot. It's generally an interest rate sensitive sector, more so than your cash rich kind of more blue chip names, if you will, the Dows of the world, collecting those, the NASDAQ much more tilted in the direction of riskier, more capital hungry names. And not surprisingly, the Dow is doing much better than the NASDAQ is today, with the S&P, which is kind of a washing of the two, sort of in the middle. So it seems to all make sense. But there might be more here than just that simple explanation. Consider first that that explanation might be right, and there may be more to it. It need not necessarily be something else. So it's this and that rather than this or that. And it's the and that starts to get even more hairy. Consider that relative to what we're seeing at the short end of the curve, the long end of the curve, longer term bonds are performing quite a bit better. look at it in terms of how the bars look compared with the prior day's gains. So here's, again, the 2-year note showing that we're erasing quite a bit, in fact, the majority, of yesterday's rise in bonds and thereby decline in yields. Now look at the 10-year. Again, we're in a situation where yields are up, but relative to yesterday's yield crash and bond surge, much less so. The retracement much more modest. If we look at the 30-year, it's even more modest. And if we take the extra step and look at gold, it's actually up a bit. And so the question then becomes, okay, so this is supposed to be about the Fed holding rates higher for longer or maybe even hiking them more. How come gold isn't falling? It yields nothing. It fell all of last year with stocks because they were responding to Fed rate hikes. How come it's holding up? We have a very different experience at the front end of the curve, which is more sensitive to the Fed, than we do at the back end of the curve. Why? Well, the back end of the curve tends to absorb more haven demand. So at the back end of the curve, you might say, well, it's risk aversion. Capital is scared. It's moving into liquidity havens, not just in the dollar, but also in the 10-year, the 30-year, which are very, very liquid, relatively stable, as opposed to the front end, which is much more, as we said, sensitive to policy in the near term and therefore inherently jumpier. So maybe that's what's going on. There's a degree of haven demand. Well, then why is gold not falling? Well, because perhaps what we're seeing in these curve dynamics and what we're seeing in gold reflects not just what the Fed might do or what Powell might say, but a realization of what the consequences of those things are in the current market environment. The Fed need not necessarily say anything different than what it's been saying in order for the markets to be spooked. The markets just need to care and think that what the Fed is saying is scary for them now versus not scary for them before. And the circumstances might well change. There's a very simple example here. Well, if you're not wearing shoes, it's not a problem if you're standing on comfortable carpet. But if suddenly the floor caves in under you and you fall, well, then maybe you might wish you were wearing shoes. And so it's that kind of thing. It's not inherent that the Fed's statements are bullish or bearish. But if the circumstances in which those statements live change, well, then the market reaction changes. And what we've learned over the past several months that the Fed has been basically saying the same thing is more and more evidence has presented itself to suggest that the circumstances are indeed changing. And so to see gold here not falling, to see the long end of the curve hold up better than the front end to a fairly obvious extent, you get the sense that it's not just that borrowing to invest will become more expensive, much as was the reason for the risk aversion last year, but that the weight of that increase in borrowing costs is finally starting to really hurt the real economy. Let's review why. We know that the Fed's job here that disinflation which is left sits with the service sector. Goods inflation has been all but squeezed out. Food inflation is a less important component over time, although it's still positive. It's minor. Energy is now a disinflationary component. And when we look at what's going on with services, it is here that you still have this fat wedge where to get from 3.2%, which is where we were last CPI number, down to 2%, that's where the meat of the action is. Why does the Fed need to do this? Why does the Fed need to act? Why wouldn't the tightening that's already been done get us there eventually? Looking at the priced-in expectations in markets, we can see the market simply doesn't buy that enough has been done. The 2-year break-even, which is the bond market's expectation for near-term inflation, as well as the 1-year U.S. dollar inflation swap, the swaps market expectation of near-term inflation, they haven't budged from essentially a sideways drift in months. And they tend to lead CPI by about 2 months or so. Now, what this says is, though the Fed has seen a monetary policy outlook that has become substantially more hawkish over recent months, even just in the way that the expectations are framed, we nevertheless are in a situation where the market has not moved in response. Here's what we mean there. If we take a look at where the market was after February, where we got the situation with the run-up in Fed rate hike odds, setting off the SVB-led banking crisis and all the chaos that followed that, and then shortly thereafter, right on the heels, the debt ceiling debacle and the speculation that maybe the U.S. is going to face some kind of a serious fiscal headwind if the negotiations don't happen on time, and there's got to be some sort of retrenchment in government spending while the negotiation is done. Surely nobody seriously considered that a deal wouldn't get done. That would just be silly and ludicrous, and the markets would collapse if that were a real chance. But clearly the markets didn't collapse, so it wasn't a real chance because, frankly, to price in the collapse of the market's default risk-free asset, U.S. government debt, means that it's not only that the markets have gone down, it's that the markets don't exist. Because that is such a fundamental aspect of market structure that you would be essentially asking a house to stand without its foundation. And we certainly don't have levitating houses yet. So it was really about there being a fiscal hit to growth that ultimately didn't materialize because we got a deal done. And a banking crisis that could have been more but wasn't and hasn't been so far. And so over the course of May, let's call it the beginning of May through to now, the Fed funds rate that's been implied into Fed funds futures over a 12-month period from any given point, not at this meeting or that, just 12 months forward from any given day, has gone from about 3.6% up to now about 5%. So the rate that markets are expecting a year forward from any given day over the past several months has gone up in excess of 125, 130 basis points. It's almost moved the equivalent of 6 rate hikes. It's sort of in between 125 and 150 basis points, depending on when you look in recent weeks. In that time, that we've had such a significant adjustment in expected rates into a more hawkish setting. The 2-year break even hasn't budged, as we can see here. The 1-year inflation swap hasn't budged. So the Fed's reaction function, its ability to influence market expectations, looks broken. The markets simply don't believe that the Fed is doing enough, or these inflation expectations would be going lower. This, of course, is a major issue for the Fed because it directly undermines what it's trying to do. So how is it going to action this? How is it going to convince markets that it's in this game? Well, we just said that services is where that action is. What is it that's keeping inflation up in the service sector? Labor. We can see that at the current time, we are looking at the largest mismatch in labor supply and demand post-COVID that really we've seen in the modern period. Let's call it from the start of the Volcker disinflation in the 80s up through now. So let's call it 40 years or so. We can see that with the onset of the pandemic, we had lockdowns, and so labor supply surged relative to demand. And then as we got into 2021, lockdowns eased, people went back to work, but we're still dealing with the hangover from COVID. We're dealing with an accelerated exit of retiring baby boomers who were already creating a deficit before COVID, but a much more narrow one, a deficit closer to perhaps about 1 million workers, maybe 1.5 million at its peak in something like 2018. What we're looking at now is a gap north of 3 million. So more than double than before, because more baby boomers decided to retire early during the pandemic, during the lockdowns, and because supply chains have changed, and because the way that work is done has changed, et cetera, et cetera. But there clearly now is a very significant mismatch, and addressing it from the supply side isn't tenable. You can't just magically clone more workers, and the experience of Canada suggests that even a very popular, a very aggressive, and a very ambitious immigration effort by the government to try to import enough workers to close these shortages isn't the answer, or at least in the Canadian example, it doesn't look like it's the answer, because it's just something that's proving insufficient. And so the only way to seemingly address this and to squeeze inflation from this part of the labor market, and therefore from the service sector, where most people are employed, is to hurt demand for labor. And the only way to do that is to hurt the economy and get businesses to lay people off. So from the Fed's perspective, its job is to squeeze hard enough that labor demand gives way enough to bring inflation back to where it needs to go. And the markets, for their part, need to think that effort is credible for inflation expectations to move down. Otherwise, where we sit here is the Fed is priced for perfection. The 2-year break even, which is about the Fed's policy window, is exactly at 2%, which means that virtually nothing at all can go wrong for 2 years, lest we get off target. That's obviously not the kind of thing that the Fed wants to have happen, because number one, it suggests that they might have to scramble in a hurry. Number two, it suggests that they're not going to comfortably sail into being on target and are constantly having to sweat near-term developments. And of course, number three is its reaction function on markets appears to be broken. Because if that heady rise in expected rates were working, these expectations would go down. But they are not. And so as the Fed looks at this, it can't even be confident that it could do more at this stage, because that which has happened spontaneously and organically in markets, i.e. risks of a banking crisis, eased. The Fed didn't mandate them to ease. They took actions, and the markets saw those actions as credible. The debt ceiling thing was not mandated over by the Fed. It resolved in a way that the markets then reacted to. What the Fed sees in that adjustment then is something that didn't work to drive expectations further lower. And so perhaps the time for activism and for doing something rather than letting the markets do something is at this point here. And again, this is the goal of doing something. It's to impact this. If we look at market expectations as they stand currently, we have about a 55% chance of a rate hike before year end at this point. It's come into the picture now. It is expected in November at this point. We then have an easing cycle starting in June, which is later than it looked even just a week ago or two. There was some speculation it might be March or May. Now it's June. But we're still looking for about 4 cuts over the course of next year. 3 of them are fully baked in, and about an 82% chance of a 4th one is priced in for December. That 4th one fully baked in by the time we get to January. So there's still a significant easing cycle that's implied here in the back half of next year. Now, what may be different and why the markets may be reacting to this differently is there is now much more at stake if the Fed continues to twist these expectations into a more hawkish direction. So if whatever the Fed says, whatever Jay Powell says at Jackson Hole tomorrow gets that percentage of another rate hike this year closer to 60, 70%, but perhaps even more importantly, if the outlook for easing for next year is eroded further, if it starts looking like 3 cuts, not 4, let's say, and if those cuts come later, well, that starts to look a whole lot scarier, because what's going on now is evidence mounting to suggest it's the U.S. economy and the U.S. consumer, the very labor that the Fed is targeting, that is upholding a global economy that would otherwise be in recession already. Talked about this earlier in the week, but here's what's going on with global growth. We have a situation where we had a pop in services at the start of this year as some of the pent-up spending on pandemic derailed activities had a bit of a catch-up run. So things like travel and restaurants and live entertainment, there was a bit of spending left to do on those as lockdowns eased and more people got over their anxieties of kind of getting back out there. But that has crested. Services is now starting to catch up on the downside to anemic manufacturing, which got beaten into contraction territory last year by Fed rate hikes and has generally stayed there since September. This is worldwide now. Services unraveling and catching up on the downside. Services, of course, the largest component of most economies relative to manufacturing. And so that's pulling down overall growth also, looking at that composite number. And the figures that we got on this, updating the numbers this week, look about as awful as one might imagine. Bit of a green shoot here and there in Japan, although we've talked about the idea that their second quarter GDP number surged as a mirage, as smoke and mirrors, because almost all of that came not from a pickup in economic activity on the domestic front, but rather from the external sector, from net exports, where there was a bit of catch up on the export side, but really the driving force was a drop in imports. So what's going on in Japan is much more a story of anemic domestic demand having an impact on the trade numbers than anything else. Although, in fairness, we can clearly see here that though manufacturing in Japan continues to contract, the numbers continue to be below 50, the service sector did cautiously accelerate a little bit. But that's an exception. The situation in Australia continues to point to deepening economic downturn. The situation in the Eurozone has to contend with a slower rate of contraction in manufacturing being the good news. So the number went from 42.7 to 43.7. So manufacturing in the Euro area is contracting a bit slower, but nevertheless contracting at a blistering speed. Services now in contraction territory as well, though. That was a nasty surprise. And the composite index, much lower than expected, showing the economy is now shrinking for the third consecutive month, fourth consecutive, depending on if you consider a 49.9 number to be enough to say contraction or just wash it as standstill 2 months ago. But in any case, this looks like the Eurozone is all but certain to be in recession at this point. The U.S. numbers came in weaker. Manufacturing shrank faster than expected. Services weaker than expected. The composite index now basically at standstill at 50.4. So the picture overall looking increasingly weak at a time when the global economy was already weakening. Consider, though, the Eurozone in contraction, the U.S. is not. What are the drivers of global growth? Well, you can see here the overwhelming majority comes from three economies: China, the Eurozone, and the U.S. The rest of world number, about 43%, is actually overstating it because a lot of those economies are vendors to the former three, and so the former three account for a bunch of the growth in that 43% in addition to their own. The Eurozone is in recession, or is very nearly there, as these PMI numbers suggest. China can't really get off the mat since trying to reopen after COVID restrictions were lifted in December. Those numbers look so god-awful that CPI has actually slipped into negative territory at last reading. Both imports and exports are dropping by double digits month in, month out over recent months. So the situation in China is looking absolutely dire. The housing market is coming undone. That's a huge part of the overall economy and really the essence of China's growth model for the past 30, 40 years. That's coming unglued. That leaves the U.S. And in the U.S., you now have a Fed with an inflation expectations problem that does not want to signal to markets that it is going to give them any kind of lifeline, lest those inflation expectations actually go the wrong direction. It's bad enough that they're not going in the right one. So what we're left with then is a situation where the markets look at this and say, the Fed chair need not actually say anything scary. He just needs to repeat the things that he's been saying. But now in the context of the dour picture on growth, we fear this because it seeks to kick out the last leg of the global growth stool and degrade the last line of defense before global recession. And this is why gold is holding up. This is why longer end bond yields are not going as high. because the market anticipates, perhaps, that it's global growth we're fearful of now, not just higher for longer interest rates, but their consequence in the immediate term. So really, if the Fed chair says nothing to alleviate market worries and just sticks to the script, we may end up with more weakness in stocks, more weakness in yields at the long end of the curve, a more supportive environment for gold, a stronger US dollar, and perhaps a stronger Japanese yen as well, which tends to do well when outright pandemonium strikes markets. And that is macro money for today. It's also the last macro money for the week. We're here Monday through Thursday, right after overtime with Chris Vecchio, the head of Futures and Forex here at Tasty Live, where he and I discuss the day's events and try to make sense of them. I will be on with Chris for Futures Power Hour tomorrow to talk about the impact of the Fed and what that all looks like, so definitely come join for that. We'll no doubt pick up the same narrative on First Call with Tom and Tony on Sunday. I'm also opining on the news and insights section of tastylive.com. In fact, Chris and I have a little bit of a debate piece there now. I say Jackson Hole will be impactful. He says no, and we have it out in print. I'm also offering commentary via Twitter. Yes, Twitter, at usd-jpy. Thanks very much for joining, everybody. Happy trading. See you next week.